In today's video, I'm going to show you 4 order flow techniques you can use immediately. If you don't have the basics of how order flow works, I encourage you to watch my free order flow course first. The first order flow technique we'll talk about is the volume profile. There are many techniques associated with the volume profile, but we are going to focus on one of the most powerful ones, which is the use of the volume point of control as a support or resistance level. Whenever you see price starting to retrace against a previous price movement, you can deploy the volume profile to see the volume point of control, which is the price level where most of the trading activity happened. The reason you want to do this is because the volume point of control represents a level where the market has found fair value. These levels act as magnets for price. They can attract and repel price action, so they will work as great areas of support and resistance. For example, in this chart, we see that the market has made a movement up and is now starting to retrace. Notice that on the left, we have an area of consolidation. The volume profile is very useful to pinpoint the price level with the highest level of activity in that consolidation, and this will form a strong point of support in this case. The idea here is to plot the volume profile over the area of consolidation like so. The red line represents the price level with the highest degree of activity. We then extend this level to the right to project a level of possible support. Moving price into the future, we can see that the market does come back to this area, and perhaps most importantly, it produces a clear reaction to that level. The students of my courses will also quickly identify this as a fractal candle. There are other ways of categorizing this candle. Some people call this a pin bar, reaction candle, or even a hammer, although these classifications point to different meanings. In this next chart, we can see that price was indeed attracted to the VPOC and then immediately repelled from it. Keep in mind that this doesn't always work in this way, and there are other reasons why price reversed in there. The idea here is to show the objectivity provided by the volume point of control. The second technique we're going to talk about is the stacked imbalance, which can only be seen using a chart type called the footprint. The footprint chart shows the volume activity behind candlesticks, so it's a great tool to contextualize what happens with pure price action. Recall that price and volume are the two most important types of information generated by the market. All technical analysis methods and techniques are based on price, volume, or both. We begin with the raw candlestick chart to have a first assessment of price action. We can notice two main retracements here. Moving on to the footprint chart, we have this view, which can be a little intimidating for people who are not aware of order flow, but it's not as complicated as it seems. The stacked imbalances are the small columns that occur on the side of the bid or ask columns. On the left side of the chart, we have a massive stacked imbalance in the ask column, which represents buying aggression. Recall that the footprint is a historical order flow tool, so the ask column shows buying aggression, unlike the order book or DOM, where the ask column shows selling intention through limit orders. If we extend this large ask stacked imbalance to the right, we'll notice that the next retracement stops exactly when it meets the area outlined by the stacked imbalance. This happens because this is an area where buyers have demonstrated aggression in the past, and the market will remember that, assuming that no new relevant information has changed the perception of buyers and sellers. The same phenomenon can be observed in the next retracement, but in a less obvious way. In this next chart, you can see that I marked the largest ask stacked imbalance in the movement up. By extending the stacked imbalance to the right, it becomes obvious that the next retracement stops at the stacked imbalance in the same way it did in the previous example. Keep in mind that, like with any other technique, this doesn't work all the time, otherwise this would be too easy. The best way of increasing the win rate realistically in any strategy is to combine several techniques together, but that's a story for another video. The idea here is to show you how the stacked imbalance can be a great ally in determining supply or demand zones, if you will. You can certainly combine it with the VPOC technique as well. In fact, that's a great idea. The next order flow technique we'll talk about is related to an indicator called anchored VWAP. The anchored VWAP is an extremely interesting tool with many techniques associated with it. In this example, we'll talk about one of the simplest of these techniques, which involves plotting the anchored VWAP on an important market extreme and then observing the price reaction to the main VWAP line. In this gold futures chart, we can see a downtrend. If we plot the anchor VWAP on the highest high, the benefit of this tool becomes immediately obvious. The main VWAP line in black is capable of catching the first two retracements, leading to potential short trade opportunities as it is highlighted in the red areas. The red lines are moving standard deviations of the main VWAP line in black, and they behave similarly to the moving standard deviations of the Bollinger Bands. Notice how the 2 and 3 standard deviations in this case point to areas where price is extended. This can certainly be used as areas for defining a target, for example. Just as an additional detail here, which has nothing to do with anchor VWAPs and order flow. Notice how the plotting of an Andrews pitchfork on extremes 1, 2, and 3 capture the limits of the following downtrend with an amazing precision as it is highlighted in the red areas. The Andrews pitchfork is one of the best tools available, and you can learn more about it in my premium courses. If you combine the best of price action with the best of order flow analysis, you have an absolutely amazing combination of tools. The fourth and final order flow tool we'll talk about is the cumulative volume delta divergence. The CVD shows the accumulation of the difference between bid and ask volume, and it serves as an indication of exhaustion or absorption of buyers and sellers. It works very similarly to the idea of momentum divergence. In this illustration, you can see a blueprint for the exhaustion and absorption signals in the CVD. Let's observe an example of selling exhaustion, which is when price action forms a lower low, while the CVD forms a higher low. This is the 2-minute chart of crude oil futures at the top. At the bottom, we have the TradingView's CVD indicator, which prints the CVD in candle form rather than a line. This has some interesting implications, such as the more accurate geometric analysis of the CVD window, for example. Notice how price action forms a lower low while the CVD forms a higher low. This means that in terms of price action, sellers are being able to advance, but there isn't enough volume to sustain the movement. This is why this is logically called exhaustion pattern. One question that usually emerges when traders deal with divergence signals is how can we know when the movement is finished? There is not a black and white answer to this question since reversals happen in multiple ways. However, by expanding your knowledge of technical analysis, you can spot things that are highly suggestive of a reversal. For example, as soon as price action makes a lower low, after producing a series of bearish candles, it forms what is called a hook pattern, which is when an inside candle of the opposing bias appears after a clean movement like that. The classic entry here is to wait for price to break the high of the inside candle. In this case, the combination of the cumulative volume delta divergence with the hook pattern was very successful, but it will not always be like that. Recall that price reversals can occur in multiple ways, so if you narrow your analysis down to setups, you will miss a lot of opportunities. These 4 techniques are very simple, but they are also very powerful and quite easy to use. However, price action and order flow analysis go much deeper than this. In this video, I'm just showing you a brief example of how these great tools work. I'm currently creating an advanced order flow course, but in the meantime, you can check out my free order flow course here on YouTube. If you want to get more knowledge about fractal price action, I offer a wide array of courses. I also offer some ebooks on institutional trading strategies in the realm of arbitrage and hedging, which have nothing to do with price charts. If you want more details about the table of contents of each, or if you are interested in bundle deals, you can visit my website fractalflowpro.com or send me an email at support@fractalflowpro.com. If you made this far and found value in this video, please help support the channel by clicking the like button, subscribing to the channel, activating the notifications, leaving your feedback below in the comment section, and sharing the video. Thank you for watching, and I hope to see you in the next videos. Take care.